I will also be back to help you with your projects. We probably won't get a chance to today. So I'm going to go over the financial accounting. We're going to basically walk through this here. I will walk through it pretty much in order except for one section. I'll move around a little bit, okay? Does everybody have one of these? We have 5 pages of this here. Dr. Sweet will cover the managerial accounting. Let me just kind of walk through some of the things here. So on the front page, and please, you're welcome to keep these and write notes on this, so that way you can study this information here. And some of this will be covered by probably Dr. Chaplin in his review of econ. The first things are the assumptions. The economic entity, what type of entity is it? We'll talk about that a little bit later in this year. Is a corporation, those type of things, partnership. Going concern, understanding that a corporation is a going concern, especially if they are struggling and they're going to be around in a year. That's typically what the going concern means. IFRS refers to everything as a going concern because something could happen and they can all go. That's the international standards. US, is it going to be here in the next year? And then that's what our going concern is. Monetary unit, what you're using to base everything off of. Here in the United States, obviously it's a dollar. Many other places it's their money, so it could be the pound, yen, those type of things there. And periodicity, understanding that the information is in a certain period. So it could be a quarter, a year, whatever it may be. Now principles, historical cost. On the balance sheet, everything is done on historical cost. So what you purchase it at, and then you may depreciate it on that. But it's done on what you purchased it at. So remember those things there. Revenue recognition. In the revenue recognition, when do you recognize that revenue? So if you have a landscape company and you get a bunch of cash in, because they pay half of it up front, and you haven't done anything, that you do not recognize. That is unearned revenue. Not until you earn it. So you've done some of the work and you've been paid for part of that there. So if you've done half the work and you've been paid half the money, then you can recognize that money. Pretty good there? All right, matching expenses to your revenues. So I'm just going to write some of this as I'm talking here. So matching those revenues and expenses as they occur. So landscape company matching those revenues as you're doing some of those expenses and purchasing the sod, the whatever it may be as a part of that for the company. And then your full disclosure. It's very, very important to make sure you have full disclosure, as in putting all the information out there. Sometimes there are things happening in the world. Yesterday I was talking about Qualcomm and some of the things that are happening with them. And it needs to be stated in their notes that there's a lawsuit right now that they're going through. That's a part of that. And anytime lawsuits, those type of things, or how you're coming up with your numbers. Not just you have $100,000 in cash, but where is it, what is it, how is it being allocated there? Because it could be in marketable securities, those type of things there. All right, constraints. We've been into that section now. Cost versus benefit. So when we do audits, we could audit everything, but the cost of doing that would cost you way too much. So there is a certain parameter that we take a look at that gives us the information that we need. So that's why we may do only 20% of the stuff we may audit, and then put that out to what it would be for the whole thing. Because the cost versus benefit. This wouldn't benefit us too much to do that versus that cost. All right, materiality. So in an audit, you're looking to see if there's mistakes. But we're looking for material mistakes. $1 to me, or $100 to me is important to me. If I lost $100, it'd be important to me. If a company loses $100, that's not material to them. It's a penny in relation to me. And so that doesn't mean that much to them. So that's what materiality is, and just material to them doesn't mean much to them, that company. All right, industry practices, it's pretty self-explanatory there. Whatever the industry typically does, regulations, those type of things there. And then conservatism. It's very, very important, conservatism-wise, to be more conservative on the financial statements. We're not looking at them as worried that they're shooting too low. We're more concerned that they're shooting too high, because what they're trying to do is get their stock to go up. We're not worried about being too low as a part of that. but we want to be more conservative in our approach and not say we're going to make billions of dollars when we need those steps to get to there. And so that may be also the case as you do your projections on your financial statements for your senior sim projects. Don't be overreaching as part of that, but you want to be pretty optimistic on some of those areas there, okay? We'll talk a little bit about those as we take a look at those. All right, any questions in that first section there, the accounting concepts, just the basics on that? All right, now the next few sections here, I'm going to work through the board here. I'm not going to start with the accounting equation. I'm actually going to start with the income statement, and I'm going to walk through how it all flows together and works together. All right, first things is the income statement. There are two sections that go into that income statement. First thing is your revenues. We have our revenues here, which could be sales, could be a lot of other things that you get money for, services that you do. I'm just going to put sales there. So the money that you generate coming in. So I'll use that example of the landscape company. I'm doing services, I'm doing sales, that's what I'm getting the money for. The next thing is, you're going to have cost of goods sold. So if I'm Walmart, I make a sale of milk, well, it costs me a certain amount of money to buy that. So if I bought it for $1.79, it may have cost them 80 cents or something like that, and that means their gross profits is then 99 cents, which gives me my gross profit right here. Now, obviously, there's more stuff that goes into that, right? Because I have overhead, I have all these other things, I have marketing, I have all these other things that go into that. And that'll be your expenses. And we'll call them operating expenses. You can break these down, but they're not going to break it down in the exam. After I take those away, I come up with my net income. Or loss. Please, on loss. Questions on that? Should we all review? You guys have to understand that? All right. Next thing, statement of retained earnings. All right. There's a reason why we do this flow, and I'm going to show you in just a moment here why we have this flow that we do. All right, so you have your beginning balance to that. So after the end of the first year, we have $3,000, whatever it may be. All right, and then we're going to add in our net income. That's why you need the calculator right here, and it flows into that. And you're going to take away dividends. What you're paying out. That gives you an increase or decrease, depending on, in your retained earnings. I'm just going to call it RE, retained earnings, okay? And then you'll add or subtract that from your beginning balance and get you in your ending balance at the end of the day. Questions on that? What's that? So this would go into your equity, your equity, your capital that you have. Yeah. All right. So next thing I'm going to do is your balance sheet. So the balance sheet's the next one. And there's a reason why I did this one, because this one will flow, this ending balance will flow into my retained earnings. All right. The first thing on the balance sheet is assets. And remember the accounting equation? We'll put it down here. Assets equals liabilities plus owner's equity. So I'm going to start with assets. I'll move over there for your liabilities and owner's equity. All right, in the assets here, So assets, we have current assets. Just remember what those are. Those are the things that we turn over within a year. So, such as examples of that, cash, accounts receivable. Could be inventory, marketable securities, those type of things. And then we have our fixed assets, or PP&E, plant, property, and equipment. And that could be land, building, equipment, those type of things there. Things we're going to keep for longer, for more than a year. And we may depreciate. So remember, there's depreciation on these except for land. The reason that, what I always tell people is just remember, land will be dirt. Dirt will be that way for the rest of forever. So there's no depreciation there. All right. Questions there? Now, one thing I do want you to see, because we're going to talk about debits and credits in just a moment, after I'm done with all this. The normal balance, the plus side is a debit to increase this on this side here of the equation. So that means to take away from it and credit it. Okay? I'll put that here too. The other side here, so we increase, I credit it. Decrease it, I debit it. And that's both for liabilities and equity. All right, we'll move over here and do the liabilities. So liabilities are things that we owe, and it could be accounts payable. Basically, those are things that we may owe in the short term. So these are current liabilities here. It could be the current portion of notes payable, which is a longer term payment schedule we may have for that. And then we have, you could have a mortgage payable, something, a building or something like that. You could also have bonds payable. These are all both longer terms. Just like if you had a mortgage payable in your own house, you're going to have a longer term than that, 15, 30 years, something like that. So I'm going to add in then owner's equity. In this section here, you have common stock. You may have preferred stock. And you also have retained earnings. That number I get from over here. That's why you do the retained earnings statement before you do this statement here. All right, questions on that? Now I'm going to do the statement of cash flows. So they all flow together. There's 4 statements, they flow together as a part of that. So statement of cash flows, I can't do that without cash. That's my check. Now there's 2 ways of doing the statement of cash flows. There's the direct method and the indirect method. I'll go through both real quickly here. Now there's 3 sections though that we need to look at. First, the operating activities. You have your investing activities. And then you have your financing activities. I will probably have to go back over there. All right. So on the operating activities, that's the stuff that happens in your operation. That's your cash from customers and that's your payments to creditors or suppliers. This is the direct method, which is the easiest to for us to calculate. Harder to get the information though sometimes on that. So companies don't use this typically, and this is not the one that is required by the SEC and other agencies. 99% of them use the indirect method. That's a part of that. So we'll take a look at that, but they cover both of them in the ETS, so I'm just covering that. That's pretty basic there. So in the indirect method over here, this is a little more complicated. So in here, so we start off with our net income. Is the first thing that we have. So we have our net income. That's why we had to do this too over here first, which is the income statements. And now we're going to take changes to those things there. So we're going to add back any depreciation. I'm not going to go over the amortization and those type of things there because it's not going to be on that. Typically depreciation is going to be on the ETS. So that's the only one that you need to really kind of worry about. So you're going to add back the depreciation. Why? Because it was a non-cash item. It has not, don't cash transact as part of that. So we're going to try to figure out and calculate those things. All right. And then what we're going to do is changes to the assets, current assets. So one of the things to remember is if my accounts receivable went down, that means I collected money. That's a positive. So it works opposite a little bit of what you think of the current assets. So if my inventory went down, that means I didn't purchase as much inventory, I used what I had. So therefore I kept the cash. Make sense there? Kind of how that's working there? So, if my accounts receivable, I'm just going to call it my AR, goes up, I will subtract. If my accounts receivable goes down, I will add. Okay, and that goes the same for as part of that. And you'll look at all the current assets there that you have, including to be paid, expenses, and those type of things. We're looking at all of them except for the cash one, because we're trying to calculate the cash. Now we'll look at the changes to current liabilities. So if that goes up, then I'm going to add it. I'll go with this in just a second here. If it goes down, I'll subtract it. So what does that mean? If I don't pay my credit card bill, and my accounts payable goes up, that means I still have the cash. It doesn't look good if I don't pay my bill, but I still have the cash. And so that means I increase it. If I do pay it and pay it totally off, then I don't have the cash for that because I used it to pay that credit card bill. And that's why I'm taking it away. Everybody follow me there? All right, so this is the indirect method. Just the basic understanding of that. And even you accounting students, this is where you guys get tripped up a lot. And this is where the CPA exam, they get tripped up a lot, is this confusion in that area there. All right, so that is the operating activities. Direct method, indirect method. Investing activities, what you're looking at there is fixed assets. And that's all I'm just going to put here. Fixed assets, I'll give you an example. Typically, these are fixed assets, and it's things that you're using for your operation. So changes, if I sold my building, that's cash in. If I purchase a building, that's cash out. Land, those type of things, same thing. It's what I'm going to use for my operation. So I'm investing in my operation. That's why it's called investing activities. Even though it seems like it might be financing, because that could be financing part of it, it's not. That's what we're looking at here is that investing activities that we are using, buildings, land, those type of things, for the operations. And then finally here, your financing activities. That could be stock, bonds, loan, those type of things here that we're using to finance those things. So for us, selling part of my company, if I'm Apple, I'm selling and putting out stock out there. What I'm doing by that is generating money. I'm bringing cash in. Because when they purchase that money, that comes to me. Now, the secondary trading out there, as I'm just moving around, is separate as a part of that. When I first put it out there, that money comes to me because I'm putting out that. Same goes for a bond. So if I purchase or sell bonds out there, my company, that increases my cash. Companies do that even when there's not a lot of, even if they don't even need the money, because if the money is inexpensive, they know that they can use that money in a better way and make money on that. So Apple did that a couple years ago, when money was cheap. They had billions in the cash. They went and got more cash, just so because money was cheap. So they increased that. But by the same token, is if I buy back stock and bring it back in, which is treasury stock, we'll talk about that in the last part of this. That's bringing money. Then when I'm using that cash to then pay that off, bring that back in. So that's a decrease in my cash. Everybody follow me there? At the bottom line here, this should match my cash. My increase or decrease, so that I have my starting cash. These changes, all these changes, added or subtracted, should be my ending cash. This should match the cash up here. And that's my check. So those are the 4 financial statements. Starting with your income statement, statement of retained earnings, your balance sheet, and then moving over to your statement of cash flows. That's how they all flow together, and that's how they work together. All right, questions on those? That's a quick run through of all of that. Hopefully you got all that. All right, so I've talked about number 3, A, B, C, and D. And I talked a little about debits and credits. Let me go a little deeper on that. One of the things that you can see here is how it flows together, right? So, in the income statement, it flows together too, because this section over here is where your income goes into. So what your revenues flow into here, and that's a credit. And your expenses are a debit. Because it's your routine earnings. Okay? So debits and credits, that's how they work, it's subtracting. So if you remember over here, the credit on this side here, it increases, and a debit decreases, which makes sense. If I make money, I'm increasing, I'm bringing in revenues and cash, and decreasing using expenses. So that's how they flow together as a part of that. So to increase my accounts payable, I would then credit that. That means I put more on my credit card. Now, remember you took financial accounting from me, I always told you to throw away what you know about debit cards and credit cards. Remember, it's left and right. This side is this. On the right side is this. One of the reasons why I broke it up the way I did. Split right here. All right, questions on those? They give you kind of some information there about the assets, allowances. Now, one of the things I didn't talk about was the allowances for doubtful accounts, or which is it's a contra asset. The one you really want to remember is that one, and then also depreciation from these. And basically, what they do is take away from those. So they work as the opposite. That's why it's contra asset. They take away from those. Yes, sir.
Would the amount going back into investing or owner's equity depend on the industry, or is it pretty standard across most?
You mean for retained earnings? Or what do you mean?
For, yeah, statement of cash flows, like
It varies a lot because each company do many different things. They could borrow more money, they may be doing well, so they have cash from operations. They may not be doing well, so then they have to sell off some of their buildings and those type of things. So it varies quite a bit, and by industry also. Yeah. All right. So moving in towards, let me move on to the 5 then. All right, so accruals and deferrals. So one of the things, you don't need to know this super well, but just kind of understand the facts that accruals, basically what happens is that things don't always end the way we want them to end at the end of the year. It falls into weird days. So one of the accruals that you have is that you may have some money that people owe you because you've been doing some work, but they haven't paid you yet. You haven't even billed them yet. And so that's an accrual because they owe you some money, but you haven't billed them or paid them yet, but you earned that, so you should put that down. And that's what an accrual is. And then the deferral is the other way, is maybe you have a deferral, you deferred something because you haven't paid it yet. And because maybe December 31st lands on a Wednesday, we haven't paid yet as a part of that. Because we pay on Friday. So at the end of the year, we still got 3 days left there, we need to pay those as a part of that. And that's how the accruals and the deferrals work as a part of that. You can see the accrued expenses and the accrued revenues there, and then your deferred revenues. And sometimes you're waiting on those. Again, the example I gave about the landscape company is that we get $20,000 in at the beginning, we haven't done any work. That's a deferred revenue as a part of that. We're going to eventually make that money, but we don't get that. So that's why it goes in the unearned, your unearned revenues there. All right, questions on how that works? All right, the next thing I want to talk about is 6, which is the closing process and temporary accounts. There's a closing process that we do. This here, balance sheet, liabilities, and owner's equity, the assets, liabilities, and owner's equity, stays. It is a permanent account. It continues to grow as time goes on, hopefully not shrink, but that's there all the time. This one here, we wipe out to 0 every period. Why? Because we want to see how we're doing. And then it flows, so we just wipe it out to 0. So what you have to do is close those out. I just want you to have a basic understanding of that. I can go through it all, but I'm not going to, there's a lot, and it'll be hard to remember all of that. But just remember that you're closing out each of these here. So that means we have to do certain entries as a part of that, and we put those to income summary as a part of that. So, but we're closing all of this out. And we also close out my dividends, and then also my net income, we put that to that in the journal entries. So at the end of the period, or the beginning of the next period, I start off with this as 0. I have no revenues, I have no expenses, and we start off, and we'll see how we do. All right, questions on that? All right, inventory, costing methods. LIFO and FIFO. I'm going to erase this here. All right. Let's start with LIFO. So LIFO, this is my bucket. I put stuff in the top. I'm going to take stuff out from the top. Last in, first out. That's what LIFO stands for. So basically what happens is I may never get to this stuff at the bottom down here.